All right. Good morning, everybody. It's that time again. Non-farm payrolls today. It's the last big one that we've been waiting for on the week. And when we have a non-farm payrolls, we have the opportunity for a liquidity gap. We did get the founder's notes just moments before I started to stream. So I had a chance to kind of glance at it, but I wouldn't say that I did a thorough job. One of the things they pointed out is their take on non-farm payrolls, that they don't think the number could be enough to turn everything around. Kind of gotta agree with them on the fact that when we were adding up how much mega cap has spent on AI yesterday, just on the last quarter, it was over $50 billion. And what do they have to show for it? And the markets are punishing those big tech companies for that. They're overspending. They're in a spending race. You heard it last night on Amazon where they said, "Yeah, we're spending more, and we're not done yet. We got to keep up with everybody else. Everybody's trying to outspend everybody, and what are they getting for it?" So, while the Fed is in focus and jobs are a really big part of it, we heard that from Powell this week. It's hard to see how even good job numbers is going to turn this around today when the market is throwing a fit over a combination of things, and the Fed being behind the curve is only part of it. So let's get this play today, the potential for a gap close. And I'm sure if you've been around for a while, you've heard this enough. You could probably do the presentation just as well as I could. But the whole point of the morning briefing was to go over these same steps over and over and over again. Repetition breeds confidence. The more you do it, the more you see it done, the more likely it is you're going to perform the same steps and hopefully adapt them to a style that suits you better. I know I don't cover everything that you guys trade. I cover things that I trade that I want to look at. But the steps are the same, even if you swap out the ES for SPY or QQQ, you would still want to perform the same steps, same behavior every day. And if you don't trade this gap close play, at the very least, if I can save you from trying to go short the hole or long off the top after we get one of these big events, and then save you from getting run over, then I mean that's a win in my book. So at 8:30 we're going to get data. It could look very much like this, up or down. We don't want to see a large wick at the start of the candle. So in this case, we went to the downside. There's no real upside move here. It immediately moved in the right direction and it closed near the end of the move. It didn't pull back and close somewhere near the middle. These liquidity gaps happen all over the place. Intraday, different time frames. This is a 5-minute. All the pictures today will be on the 5-minute, but they exist anywhere. The reason that these 8:30 prints are so useful is we don't have to guess when it's going to be, right? Because you can get them at 2 o'clock in the afternoon, 1 o'clock in the morning. They're everywhere. But we know at 8:30 on CPI days, we can get one right at 8:30. After the initial move is made, we get a basing pattern, and then price begins working on its gap close. And I get it. You don't see a gap, you see a candle. But it's called a liquidity gap. This moved so fast that the flows behind it, the orders that would come in on the dome, those are weak hands. They didn't exist until this thing moved down. And so even though you see liquidity in the dome, it's called a liquidity gap. And it's so weak that a lot of times we just, like a vacuum, uh, the market doesn't like a gap, we go back and we get that gap closed. We get the gap closed between 10:30 and 11 most of the time. So here's one in the other direction, up instead of down, but at 8:30, when the move started, there's almost no wick on the bottom, single direction push. We didn't really build much of a base this time, but started working on the gap close, got there between 10:30 and 10:45. Here's another one, CPI day. This one a little bit different. It did pull back off of the high, but not more than 1/4%. And if we take that candle and break it out into 4 quarters, then it stayed in the upper 25%. The next candle just kind of digesting, working out everything that was up there. And then the next candle continued the move. Got our basing pattern, started working on the gap close, got there between 10:30 and 11. Non-farm payrolls, February 9th. This is what we don't want to see. Big wick going in the wrong direction. A big wick going in the right direction. It pulled back more than that 25% that I was talking about, and it closed really close to the halfway mark. This is not what we want for a gap close play. Did it close the gap? Yes, but it was done, within an hour. This entire thing, while it may be tradable, it's not what we're looking for, right? So this is not a gap close setup that I would want. So another example of what we don't want, big wicks on each side. We closed really close to where we opened. So almost a doji in that respect. This is not what we want. There is no gap to close if we closed basically where we started. Another example, same thing. Big moves in each direction. This isn't what we want. Another example. This is not what we're looking for. Now, I mentioned that these can happen all over the place. This is a 10 a.m. economic event gap candle. So that was our first one. Then we got another one, which was closed almost immediately. Then we got another one, which sent us down and closed the first one. And then we ran back up and closed that one. They can happen all over. We have this possibility today because it's non-farm payrolls, 8:30. It's been mostly a tech sell-off with a little bit of temper tantrum that the Fed isn't cutting, but that's pretty minor compared to everything else. And they're pricing in 3 rate cuts for the last 3 meetings, right? A 25 basis point rate cut at each of the next meetings for the rest of the year. Some analysts are saying that's probably a little too aggressive, that unless we start getting some really horrible numbers, the Fed likely won't cut that fast. We'll see. So that's what's getting priced in. If you go to December, we're at 5 1/4. There's nothing here for even a 5, right? That's pretty confident that they're going to have at least 1 cut, if not 2, by this time. That like there's nothing else, right? It's not even one on the board. Not even the possibility that we would not have a cut at that point. Pretty aggressive pricing. So Hong Kong basically flat. UK down 1/4. Japan nearly 1% with the Dow. S&P down more than 1%. NASDAQ down more than 1 3/4. And small caps just getting ripped apart, -2%. As you can see, we're pretty much going to be done with our data by 10 a.m., at least the biggest data. I think there's some auctions today, I think. So just kind of look around. I could have swore I seen some auctions in there. If not, by 10, really, we're done. Should be free and clear for your afternoon trades. Shouldn't have any data this afternoon. Yeah, even Barkin is going to be speaking after the market's closed. So by the time Europe closes, your afternoon should be free and clear. Remember, a lot of this is sentiment, right? It's always worth the distinction that when there's something major going on, remember when that ship got stuck in the canal and it was messing up supply chain all around the world. Well, that was a thing. There was actually something wrong, and there was something to fix. There was something to focus on. Right now, this is all just sentiment. The market is losing its warm, fuzzy feeling. But that can change just as fast as it changed in one direction. It can go in the other direction for a variety of reasons. So, just kind of keep in mind that this isn't due to some actual thing that has happened. This is due to a combination of tells and signals that turned the market's mood sour, and they're having a little bit of a temper tantrum. I'm zoomed out on this higher time frame here for a reason. When we think about pivot points and the SNR levels, it's easy to lose track of the idea that these things expand and contract very much like price does. So if it's a real narrow range, it's not very hard for price to get below an S1, S2, S3 level because it's very narrow, right? Here we broke the S3 and really expanded lower, but it was a very narrow day. Look at that day that I just circled and look at today. It's a much wider range, right? Much wider range. We're already at the S1. Even on this very wide day, we're already at the S1. And I have to expand it a little bit just to see the S3 all the way down here. So it's a very wide range. Getting to these SNR levels is completely different than a day when we've got something really narrow, really constricted, something like that. We are back below the weekly pivot point. We're not too far below it. Try to gauge that distance of how far from the weekly pivot are we, and is it, quote, too far? I would say no, it's not too far yet. Our channel today is about as wide as it was yesterday. The markets don't get moved by these channels. These channels are more of insight into what the market could do. They're not drivers for what the market will do. We had one heck of a move yesterday, and this channel had no reflection on that whatsoever. So I'd say today is very likely the same. There's so much economic backdrop that these little tells are like gnats buzzing around. They just don't impact anything. The spot gamma index was really close to, well, let's say it's lower than 2.5. It only goes to -4. So if 0 is the midpoint and -4 is the most negative that it can go, it's at -2.5. That's pretty negative. The way that gamma index works on a sliding scale is if it's a positive number, breakouts likely fail. As the closer it gets to a +4, the more likely it is that our range will be very tight, very narrow, and that breakouts will fail. When we're below 0, when we break out, we could really expand, especially if it's to the downside. And the closer we get to a -4, the bigger that move could be. Well, we're at minus 2.5 and then some. So even though we already made a big move yesterday, don't make the mistake that we can't also make another big move today in the same direction. There's no rule that says we can't have two big move days in a row in the same direction. I know, yes, this week we already had a big move up and then we had our big move down. Well, we can yet again have another big move down. S1 is acting as a support. If we can get underneath it and expand far enough away from it, it will begin to act as a resistance. How far do we have to get below it before we would consider it far enough? And then, start to have that idea that should we come back towards it, it'll start to act as that resistance. The easiest way to answer that a lot of times is to measure what we have right now. So if we just take this range that we had here and project that to the downside 100%, and even just 50%, $53.84, and there's a cog line at $53.92. I'm pretty comfortable with $53.92, but if we want the full measured move, it's 84. If we get down that far, then we could say any movement back towards this green line, it'll act like a resistance. It's very likely that even 96, right, 50% of this move, because you could take this from a smaller range, say from that zone there. It's 5,400 and then 53.95. Visually, to me, it's more comfortable rather than trying to quantify it with some kind of math. This looks about good enough. If we get beyond that to the downside and then we come back, that's going to act as a resistance. But if we sit inside this zone, then we can just chop in that zone. And it won't act as a support or resistance. It'll act like a magnet and we'll just stay there, chopping about. As for the weekly pivot and our distance from it, I don't think we're there yet. This is not as much as we've seen previously on how far away from the weekly pivot we can get. We've had weeks where we've gotten farther away than that, but it kind of feels like we're getting close, right? Here's a pretty good size move away from the weekly pivot. And on this week, I mean, we opened so far away from it that it was like gravity. We just ran back into it. I think this is one of our biggest moves away from the weekly pivot in the last 60 days, 2 months. We've got room. $5,400 is looking pretty good though for a normalized distance from that weekly pivot. If we were looking at extremes, 5,350. Just keep in mind that the weekly pivot, I mean, it ends today, right? When we come in next week, we got a whole new pivot. And just like we had back here, when we opened this new week, we were quite a distance away from the weekly pivot, stalled out for 3 days, and we came down into it. we could open considerably below next week's pivot, stalled out for 2 days, and mean revert back to it. And look, this sell-off didn't do anything more than just come down and like reset the balance, right? And then we continued to the upside. So, next week, the weekly pivot could be a little lower than it is this week. Price may pop back up like a dead cat bounce, get a little reset off of that next week's weekly pivot, and then continue its move to the downside. We just don't know yet. But as for the distance from the weekly pivot, we're getting close to how far we would expect the market to go. In a high volatility environment, markets have a history of moving farther than their expected moves, right? Volatility is literally the nerd word for movement. So high volatility, just translate that into big moves. So how far from the weekly pivot we go, on average, we could exceed that average pretty easy. We're already at the ADR half this morning. We're beyond it. It's going to act a bit as a resistance level at this point. There is the phrase that says if we get there early enough in the day, we can go to the other side by the end of the day. But what's going to turn this market's mood around enough to propel us 80 plus points in the other direction? It's not to say that it can't happen, just where's that going to come from? We have a market maker move this morning. They're hedging. They're worried about the data that we're going to get. And because they're worried, they're trading in the front end on the options on the ES, which is what they do, right? We're in negative gamma territory. You got zero gamma and volatility trigger way up here at 55.30 something above the cog line. And when dealers are in negative gamma and they're trying to remain as neutral as possible in their positions, they have to sell into the selling to maintain that neutrality. Remember, the dealers don't want to be long or short. They don't have a dog in this hunt. They're just making book, and they want to offset that risk as much as possible and remain delta neutral. The only way they can do that when they're in negative gamma is to sell into the selling or buy into the buying if we were going the other direction. Which is why it can exacerbate, that's a fun word on Friday, the moves that we're going to see, right? It can make it much worse. Generally, when we're in a positive gamma and we break out, we're trying to have a really big trend day. As we're rising, they're selling into it, or as we're falling, they're buying into it. And that kind of tries to limit the moves that we get on a day-to-day basis. But we're not in a positive gamma, we're in a negative gamma. It is interesting to note that the VWAP has moved down with us relatively well. My VWAP resets at midnight, but I think if you go look at one that resets at 6, I think you'll find that it's been holding with us pretty good. A couple of ways to look at that. When we outrun VWAP, a lot of times we'll mean revert back to it. But if we're holding VWAP with us, then it can just be a controlled, smooth, steady grind in whatever direction we happen to be going and just keep on going. Because we're not getting any sort of mean reversion where we're moving too far, too fast. And there's no expected flip back the other way if we're not moving too far, too fast. So keep your eye on how far away we get from VWAP. And at the very least, we're likely to get some sort of reciprocation. So if we moved a 0.5% below VWAP, when we finally get above, we'll take a 0.5% above it. Thing is, we got to get through non-farm payrolls first, and that's going to give us violence one way or another. Once we're done with the market maker move, you want to see the, once we're done with non-farm payrolls, we want to see the market maker move start to decline. This thing is a time-based tool, and it's only for today. So the closer we get to the end of the day, the less life this thing has. Meaning how far the market could go as we get closer to the end of the day, it gets smaller, right? It's only 8 o'clock. So we've got hours of market left. But when it's 2 o'clock in the afternoon and we've got 2 hours left until the end of the day, then there's only 2 hours left of the day's market maker move. So through the day, after non-farm payrolls, we should see this decline really fast and then disappear probably before noon. If it doesn't, there's something else the market's worried about, because they should be pulling that hedge off after we get non-farm payrolls. And if they don't, then that's a heads up. There's something left on the table for today. And they're still hedging against it, whatever it happens to be. It's a good question. $53.50 right above that put wall. 54.11 cog line, which is pretty much where we're hanging out now. And that big one all the way down here at 52.50, which I hope we don't hit that today. We can. That's the crazy thing, is we could hit it. I just don't see that on the table. Yeah, I'm really interested to see what the door looks like next week on a lot of these equities too. I think this month I'll probably use the day one instead of the 3-day, just because the 3-day is probably going to be so big that it probably won't be very useful. Could be wrong though. I don't have a lot of examples of really big 3-day doors. The 10-day profile is just absolute mess. There's nothing here. The one thing we could say with certainty is the point of control is not going to move anytime soon unless we land in some massive iceberg down here and gather up a bunch of volume real quick. Any move to the upside has 5,500 as a significant resistance, and the zone starts at 5460 area. I mean, this whole high volume node is just a monster level, 60 points, and there's no way through it anytime soon. We got a whole week before we even start to eliminate some of that volume structure. So I don't see that point of control moving anytime soon. Even if we stay exactly where we're at and we just stay down here chopping, it's going to take days to build up enough volume at this level to compete against this point of control. We almost had a classic B yesterday. If it wasn't for this little bit across the top in that Globex section. But even with that across the top, I'd still say it's a pretty good B. And those are bearish patterns. And it's now a significant level to get through. 54.72-ish. And it is a VPOC. And we don't need this one anymore because that got took out. It got taken out. So we'll just use it down here. An argument could be made that we hit it right at 6 o'clock last night. It was touched right there. Discretion has to be applied at some point. I'm going to let it ride. This is a perfect TRB also. You know, I've done videos on it, that trend line breakover. Trying to draw a line on it, it's just gonna, it doesn't even matter, right? Price doesn't see your line. So there's no reason to try to make it perfect. But the idea is that we've got a trend line breakover setup here. And it's very much like what we had back here in the other direction. So hard to see a long until we can at least get on the other side of that trend line. And when that point comes, we've got this VPOC to deal with. We've got our own halfback that we're going to be struggling with to get through. And then the VPOC, then the halfback of yesterday, which will be very close to the halfback of Wednesday. It's just going to be a major fight trying to go back up in the other direction, right? So not falling is on the table. Going lower is on the table. But going higher, it's technically possible. I just don't see a path to going higher today. So the best you could get is not falling farther. We are at the edge of the weekly expected move. 54.21 is that edge, right? Pretty close to it. 54.19. We've already got next week's range projected, but it's not set in stone yet. It won't set until after 4 tonight. As the market is still open right now, this range is still moving and it's expanding and contracting. So while this is a little bit of a preview of what next week looks like, it's not set yet. One thing I like to do on Fridays is measure the current week, what we have right now, and lay that on top of what we're expected to get next week and get a little bit of a feel for what next week has in store for us. This range is based on 2 metrics, time and volatility. There's other metrics that are in there, but those are the 2 key components. Well, we have the same amount of time next week as we had this week. It's a 5-day week. So if the range is bigger than or smaller, the only other major component that would make it bigger or smaller is volatility. We can see that next week's range is bigger than the current week's range that we just had. So the market is worried. They're pricing in more volatility for next week. They're giving the range more room for next week. And yet this week had the biggest economic events: non-farm payrolls, FOMC, QRA. What else do we have on the table? We even had some of the biggest Mag 7 earnings this week. Since this pullback began, I've continued to remind people that a good market needs a decent pullback. We had one back here, and a typical decent pullback is 5 to 7%. That's the norm. So back in April, we got less than 7. So far right now, we've only got 5.5. So, you know, if we're looking for another leg up, we got to have a really good pullback. We're not at the edge of that number yet. 5 to 7% we're only at 5.5. So we could get another 1.5% lower and we'd still be within that common pullback structure. I point that out as a reminder that if you're thinking about going short now, you're kind of a little late. And on top of that, we're not looking for a bear market kind of market structure. Not yet. Now, once this 7% pullback or close to 7%, once we're done with it, it doesn't guarantee that we're going to run up and then leg up to another zone. We could stay in a range bound market for the next year or more. It doesn't owe us more. I don't think that's likely, but just adding to the idea that even if the pullback does stop and we don't continue to go lower and lower over the next quarter, doesn't necessarily mean that we're going to do what we did last time and rally back up, test that high, and then leg up a whole new structure higher. It made 50% easy enough. That's how we got to that level. But we didn't quite make it 100% of this pullback. Most of the textbooks will tell you that 50% is your good target anyways. And that 100% of the move is your outlier, your overshot. So when you measure this pullback and you project it higher, that's your 50%. We don't have our 7% move yet. We could just throw it out there for 7 or even just measure what we got. 55.87 and then 60.32 cog line. But not yet. Still got to deal with the pullback. On that pullback, distance from 10 on average to the downside, we usually get around 2%. We just set my mouse down there and you can see 2% is the norm. Sure, there's a lot of other ones where we get, 1%, but that tends to just get run through and we keep on going. So we're only 1.5% below the 10-day. I'd say we've got at least another 0.5% lower that we could go before we start to see even the start of a turnaround. Even back here in April, we got around that 2%. Easy enough. Looking at the 10-week, we're just getting started. If we were going to get more negative, like we were, say, back in April, we got 2% below the 10-week at our final extreme before things turned. And we're not even 1% below the 10-week yet. So if we're looking for that turnaround date, we're not there. It is worth noting too how the market structure was different when you put moving average into the game. Look back at April. Once we cut underneath that 50, that's when things really accelerated. So it's kind of the key breaking point. Now we've been down at this 50 and holding the line, holding the line, holding the line until, We broke that key structural low. So if we're going to get this 5 to 7% pullback that we're waiting for, I think the wait may be just about done. Just like back here when we consolidated, waiting, and then we finally broke structure. So we'll see. It's what we need though, right? This isn't something to be scared of, and don't freak out with your portfolios and make radical changes. It's the worst time to do something like that. I think we'll start with what's up because it's the smaller list. What's up? Bonds are up still. And there was some good questions yesterday about risk parity and the idea of a continuation in bonds. There's still a lot of hand wringing over this move in TLT versus TNX and how TNX is already at these structural levels. How much lower is it going to go and what's going to break from it? The idea of TLT above 100 is kind of hard to wrap our head around. So I would say it's very likely going to break something. You know how over the last few weeks we've seen the 2-year, the 10-year, the dollar all falling while the ES and the NASDAQ are falling. Or we would see all of them rise while the ES and the NASDAQ rise. And then they would disconnect again. So I wouldn't get too hung up on it yet. Certainly things are changing though. A nice continuation in bonds today after days of moves, right? From 91.5 to 95.5. And this is not one of those big movers, right? Not generally. And we've had our line in the sand since April. We're finally through it. Remember that big sell-off we had in the S&P, that 6.5% pullback in April? We're doing the opposite this time, right? This was going down and the S&P was going down because risk parity is dead. Now we're getting a sell-off and this is going up. So that 60-40 portfolio, the idea that that could come back, maybe it's coming back, but I'd say it's still pretty early at this point. Hard to believe that we would see it up here at 100 though yet, right? Or beyond 100, let's say it that way. Could we get there? Yeah, I mean, certainly we could, but beyond that, I think we would need more first out of the Fed before we would see that. We're over the halfback though. We're into the 111 warning center. If it's gonna fail, it'll fail here. Otherwise, we're looking at 96.5 plus some. We'll get there, look for opposite candle color, see it digest above and hold this level, and then on to the next one. This one. That'd be a nice gap close. But this is a gappy bugger. I wouldn't get too hung up on gap closes anyways. Not on that thing. Bitcoin's up more mean reversion than anything else, and it's been crazy violent lately. Still down over 13.25% over the last 5 days, or down 16.25. Those are big numbers for a 5-day move. Nat gas, gold, and gold is doing really good with this move. Gold miners, bonds, and really, I mean, that's what we got, right? VIX up 23.75 in 5 days, up 10.5% today. Semis are down, but basically it's all the 5-day change. Mag 7, cloud computing, emerging markets, so China ADRs. Financials. There's China again. Ten minutes for non-farm payrolls. Yeah, for Bitcoin, that doesn't look good. I mean, sure, it says it's up a little, but that doesn't even look like a good day trade today. If we can get a breakout of yesterday, we could try to close that gap. But, Coin had earnings and Mara had earnings. Even that didn't save it, right? Right. They were up a little bit after hours. They already gave it away. I still like that anchored VWAP for coin. Mara just continues to bleed. It's already under that level. DoorDash had earnings. Coinbase, Snap, Square, well, Block, whatever. Snap was the only one that missed. The rest beat, but didn't do very good. Oh, yeah. Could get a little mean reversion here on Snap. It could bounce into resistance at 12. I think it'd be a nice short off of 12. If it overshoots 12, comes back to that anchored VWAP, then I'd short it there. But I don't think it'll make it past 12. I do expect a bounce, but only a bounce into resistance. You see the last big move, it took like a month to bounce, and the bounce didn't even make it up 0.25%, right? A quarter of the candle. This is a much smaller move. Still don't think we'll get above 12 if we get a bounce at all, but I think we'll bounce at least a little. It's worth noting back here with this really big move, if you're thinking, oh, I'm going to short the heck out of that, look after the last really big move. It stalled out after that. Sure, there was another dollar of movement in there, but that was it. So, if you're trying to short it from this low, you could get a little more, but I think you're just taking a lot of risk for a very little bit of reward. Plus, the options are going to be horrible at this point. Let it bounce. Buy those puts on the rally up, right? That's options 101. Get them in the other direction. You don't want confirmation trading when you're taking straight calls and puts. SMH hit our target. It's the 1236. We're back down to the anchored VWAP. So I'd expect a little digestion pause there. We could rally into resistance. So some sort of a bounce in that space. Probably not today. I wouldn't expect much out of the market today other than just trying to digest this move we already had. So watch the clock, guys. Get through the morning session. The afternoon's pretty clear for a 0-day play. You could see some 0-day shenanigans in the afternoon. Remember, they're going to try to turn things around. So if we continue to go a little lower, that'll set us up for a nice rug pull flip back in the other direction. But we're only talking about getting back into levels that we left behind yesterday, right? We're not talking about big expansions beyond that. So if they try to flip it and they're able to flip it, then getting back to our own Globex high and then getting to, say, the 50% mark of yesterday, that would be pretty impressive just to get that much out of it. Otherwise, expect to bleed into, say, 53.92, get that flip from way down there, get back into VWAP, reciprocate onto the other side of VWAP, and still never get back up into 5,500 by the end of the day. Be careful, be safe, have a good weekend. I'll see y'all Monday.